If you are between the ages of 60 and 65 right now, you are sitting inside the most consequential financial window of your entire life. Not the most exciting, not the most visible, the most consequential. The decisions you make or don't make in this specific 5-year window will determine the quality of the next 25 years more than every financial decision you made in your 30s, 40s, and 50s combined. Here's what makes it dangerous. Most people spend it waiting to retire, waiting for Medicare to kick in, waiting to claim Social Security, waiting to figure all that out. A Vanguard study found that pre-retirees who failed to optimize their tax strategy in the 5 years before retirement left an average of $148,000 in unnecessary taxes on the table. Not bad luck, not market timing, inaction. What I want to do today is walk you through exactly what makes this window so dangerous and so irreversible. Because unlike almost every other financial mistake, the ones made between 60 and 65 cannot be undone, they can only be managed. I'm going to give you 9 specific things that either happen in this window or need to happen in this window. Most people get fewer than 3 of them, right? And at the end, I'm going to tell you the single highest leverage action you can take right now, today, that costs nothing and protects more of your retirement than almost anything else you could do. I'm a CPA. 25 years of retirement planning. I've sat across from hundreds of families in exactly this window, some who used it well, most who didn't realize how much it mattered until it was already past. 9 things. Let's go. And before we start, drop a comment. How old are you right now, and are you actively planning for retirement or still in I'll get to it mode? I'm asking because the answer changes what I want to emphasize for you. Let's dive in. Number 1. Your tax bracket is about to change permanently. Here's where I want to start, because it frames everything else. Right now, between 60 and 65, most people are still working, still earning, still in whatever tax bracket their salary puts them in, maybe 22%, maybe 24%, maybe higher. The moment you retire, your taxable income typically drops, sometimes dramatically. If you delay Social Security until 67 or 70, and you're not yet drawing from retirement accounts, you may have a window of 2, 3, maybe 5 years where your taxable income is the lowest it's been since your 30s. That window is not a rest stop. It is the single most valuable tax planning opportunity of your financial life. Here's what most people miss. They look at that low income period and think, great, I'll spend less in taxes for a few years. What they don't see is that it's an invitation. A narrow, time-limited invitation to move money from tax-deferred accounts, traditional IRAs, 401ks, into Roth accounts at the lowest tax rates you'll ever pay again. Because starting at age 73, required minimum distributions will force income out of those accounts whether you want it or not. And if the balance is large, the IRS determines the amount, not you. I had a client, retired at 62, had $1.3 million in a traditional IRA, a small pension, and planned to delay Social Security until 70. In that 8-year window before Social Security and RMDs both kicked in, his taxable income was modest. We ran the projections. If he did nothing, his RMDs at 73 would generate over $71,000 in taxable income per year, stacked on top of his Social Security and pension, pushing him permanently into the 22% to 24% bracket for the rest of his life. Instead, we converted $55,000 to $65,000 per year during those low-income years, staying inside the 22% bracket ceiling. He paid tax on it, but he paid 22% then instead of 24 to 28% later. And he reduced the IRA balance that would be subject to RMDs. Over a 20-year retirement, the projected after-tax improvement, $210,000. Same money, different timing, completely different outcome. Practical takeaway. If you're between 60 and 65 and haven't modeled your tax bracket trajectory through age 75, that is the first thing to do, not after you retire, now, while you can still affect the outcome. But the tax bracket conversation only makes sense if you understand what's happening with Social Security. And most people in this window are thinking about it wrong. Tell me in the comments, have you modeled your tax bracket in retirement, or is that still on the to-do list? Number 2, the Social Security decision has a deadline you can't move. I want to be direct about this one. The Social Security claiming decision is irreversible. Once you claim, the benefit is set. adjusted for inflation going forward, but the base is locked. There is no do-over. There is no "I changed my mind." And yet the Social Security Administration's own data shows that 57% of Americans claim before their full retirement age, most of them at 62, the earliest possible moment, taking a permanent 25 to 30% reduction in their monthly benefit. For the average person, the difference between claiming at 62 versus waiting until 70 is approximately $1,100 to $1,800 per month for life, indexed to inflation. Here's what most people miss. The decision isn't just about break-even math. It's about the interaction between Social Security income, your tax bracket, your Medicare premiums, and your spouse's future survivor benefit. That last one matters more than almost anything. When one spouse dies, the surviving spouse keeps the higher of the two Social Security benefits. The lower one disappears. So if one spouse has a significantly larger benefit and one delays to 70 while the other claims earlier, and the survivor protection is maximized on the larger check. I had a client, couple, both 62, both planning to claim immediately. We ran the numbers. The husband had the larger benefit, roughly $3,400 per month at 70 versus $2,380 at 62. The wife's benefit was smaller. The husband was in good health, family history of longevity. I showed them what the wife's income looked like in a scenario where the husband died at 75. If he'd claimed at 62, her survivor benefit was $2,380. If he delayed to 70, it was $3,400. Over a 15-year widowhood, that difference was over $180,000. Inflation adjusted. He delayed. She claimed at 64. They built a bridge income strategy to cover the gap. Practical takeaway. Before you claim Social Security, model the survivor benefit scenario explicitly. Run it as if one spouse dies early. The decision that looks obvious in a joint income scenario often looks very different when you're looking at what one person is left with. Now, here's what most people miss about the years between 60 and 65, and it's not about money at all. Number 3, healthcare coverage. Before Medicare is a hidden financial trap. Medicare starts at 65. That's fixed. It doesn't move. If you retire before 65, at 62, 63, 64, you have a gap. And that gap is one of the most expensive and underestimated costs in early retirement planning. The average monthly premium for a 63-year-old on the Affordable Care Act marketplace is somewhere between $700 and $1,400 per month, depending on your state, your plan tier, and your income. For a couple, that's potentially $2,800 a month, $33,600 a year in health insurance premiums alone before you've paid a single copay or deductible. And here's where it gets interesting. ACA subsidies are income-based. If your income is low enough, below 400% of the federal poverty level, you may qualify for substantial premium tax credits that dramatically reduce that cost. But there's a trap. If you do Roth conversions to reduce your future RMD exposure, which I just told you is one of the highest leverage moves in this window, those conversions count as income. And if they push you above the subsidy threshold, you can lose thousands of dollars in premium tax credits. These two strategies, Roth conversions and ACA subsidy optimization, are in direct conflict with each other. And the only way to navigate that conflict is to model both simultaneously, which almost nobody does because Roth conversions live with the CPA and ACA planning lives with the insurance broker. They rarely talk. I had a client, couple, both 63, planning to retire early. They had enough saved. The husband was doing small Roth conversions on his own. The wife had found an ACA plan that looked affordable. What nobody had noticed, those conversions were pushing their household MAGI just over the subsidy cliff. They were losing $14,000 in annual tax credits to save maybe $6,000 in future taxes. The net result was negative. They were losing money doing something that was theoretically right. We stopped the conversions for 2 years, let the ACA credits run, and resumed the conversion strategy after Medicare kicked in at 65. Practical takeaway, if you're retiring before 65, your Roth conversion strategy and your healthcare coverage strategy need to be modeled together by the same person, or at least in the same spreadsheet. They are not independent decisions, and that leads to one of the most overlooked risks in this entire window. Number 4, Your human capital is disappearing and you haven't noticed. Here's a concept that financial planners talk about in academic settings but rarely explain plainly. Human capital is your capacity to earn income. It is, for most of your working life, your single largest financial asset, no larger than your 401k, larger than your home, larger than anything on your balance sheet, because it generates cash flow every month, and it's protected by your ability to show up, work, and get paid. Between 60 and 65, that asset is in its final years. And here's what most people miss. Your human capital isn't just your salary, it's your ability to make financial course corrections. You overspend in your 40s, you can work more, earn more, save more. You make a bad investment in your 50s, you can rebuild. Every working year is a correction opportunity. The moment you retire, that option is gone. Or at minimum, it becomes dramatically harder to exercise. A study from the Employee Benefit Research Institute found that 46% of retirees leave the workforce earlier than planned due to health issues, layoffs, or family caregiving demands, not because they chose to, because they had to. Which means the timeline you're assuming for how long you have to keep earning, keep saving, keep course correcting, it may be shorter than you think. I had a client, 61-year-old executive, confident she had 4 more earning years ahead of her, strong performer, felt secure in her position. At 62, her company was acquired. Her role was eliminated. She received a modest severance. She had $890,000 saved. Her original plan had assumed $1.4 million by retirement. She hadn't hit her number. She had to retire 4 years earlier than planned, with significantly less than she'd built the plan around. It wasn't a disaster, but the margin that she'd been counting on to fix any problems, that correction opportunity, was gone. We had to build a more conservative plan, delay Social Security, and restructure her withdrawal sequence to compensate. Stay with me, because this matters. Practical takeaway: don't build your retirement plan around the assumption that you have until a specific age to keep earning. Model the scenario where you stop working at 62, even if you're planning for 66. What does that look like? Is it survivable? If not, what can you change now while you still have income to change it with? But losing human capital earlier than expected isn't the only thing that can compress this window. Number 5 is something almost nobody plans for. Have you thought about what happens to your plan if you had to retire 2 years earlier than expected? Drop a yes or no below. This one surprises most people. Number 5, long-term care insurance has an expiration date. The window to purchase long-term care insurance at a reasonable premium closes somewhere between 60 and 65 for most people. Not for everyone, but for most. After 65, premiums increase substantially. After 67 or 68, insurability itself starts to become an issue. Pre-existing conditions that weren't disqualifying at 62 become exclusions or outright denials at 67. Here's the cost reality. A private room in a nursing facility runs $9,000 to $11,000 per month in most metro areas. Memory care runs higher. The average length of a long-term care event is 2.5 years. The average cost of that event for a single person is somewhere between $270,000 and $330,000. Out of pocket, because Medicare doesn't cover long-term custodial care. And here's the thing about self-insuring. A lot of people in the $1 million to $2 million net worth range say, I have enough saved, I'll self-insure, which may be true, but a long-term care event doesn't just cost money. It costs in a specific sequence, large, sustained monthly withdrawals, often at a time when the person being cared for has no control over the financial decisions being made. A $300,000 long-term care draw from a $1.2 million portfolio isn't just 25% gone. It's 25% gone at an unpredictable time, possibly during a market downturn, with no ability to adjust the withdrawal to protect the remaining portfolio. I had a client, couple, both 66, came to me for retirement planning. When I asked about long-term care insurance, the husband said they'd looked at it at 62 and decided it was too expensive. The quote they'd been given at 62 was $3,400 per year for both of them combined, a hybrid life/LTC policy. The quote at 66 for the same coverage, $7,100 per year. And the wife had developed a minor thyroid condition in the interim that limited her coverage options. The window had narrowed. The price had doubled. The choice was harder. Practical takeaway: If you're between 60 and 65 and haven't seriously evaluated long-term care coverage, put it on the calendar this month. Not because it's right for everyone, it may not be, but because the option to make that decision on your terms expires, and you want to make it deliberately, not by default. Now here's something that operates on a similar principle, and it's one of the most expensive silent mistakes in this entire window. Number 6, your asset allocation is probably still wrong for where you are. Here's the counterintuitive one. Most people approaching retirement know they should shift from aggressive to conservative as they get closer to the date. Less stock, more bond, reduce risk, protect what you've built. But here's what most people miss. The shift often happens too fast, too early, and in the wrong direction. A 2023 Morningstar analysis of target date funds, the most popular default investment in 401k plans, found that the average 2025 target date fund was holding approximately 42% in bonds and stable assets at the target date, which sounds conservative and responsible, except that a 65-year-old retiring today has a statistical life expectancy of roughly 85 to 88. That's a 20 to 23-year horizon. An allocation appropriate for a 5-year horizon is not appropriate for a 20-year horizon. The portfolio needs to keep growing to outpace inflation and sustain 20-plus years of withdrawals. Going too conservative too early is one of the most reliable ways to run out of money, not because you lost it in a crash, but because your money stopped growing fast enough to keep up with your life. On the other side, some people in this window are still sitting in the same aggressive allocation they had at 50, haven't thought about it, haven't touched it, which means a market correction in the 2 years before retirement, the worst possible sequence, hits a fully aggressive portfolio at exactly the wrong moment. I had a client, 63 years old, sharp, successful, who came to me and said, I know I need to adjust my allocation before I retire, but I don't know what to change it to. He'd been 90% equities for 20 years. His portfolio was $1.8 million. We didn't go conservative overnight. We built a glide path over 24 months, shifting to what I describe as a 65-35 allocation with a 2-year cash buffer sitting outside the portfolio entirely. When he retired at 65, his investment portfolio was positioned for 20 years of inflation-adjusted growth, and his cash buffer meant the portfolio could go down 30% in year 1 without him having to sell a single share. Practical takeaway. In the 5 years before retirement, your allocation needs to do 2 things simultaneously: protect against near-term sequence risk and maintain enough growth to support a 20-plus year retirement. That means a glide path, not a switch. Start the transition 3 to 5 years before you plan to retire. Almost there. 2 more, and these are the ones that most people leave entirely unaddressed. Number 7, your estate plan is probably outdated or non-existent. The American College of Trust and Estate Counsel published research showing that roughly 60% of Americans do not have a current will. And among those who do, a significant portion have documents that haven't been updated in a decade or more. Before grandchildren were born, before account balances changed materially, before the Tax Cuts and Jobs Act changed the estate tax landscape. Here's what most people miss about estate planning in this window. It's not just about who gets what when you die. It's about who makes decisions if you can't. A durable power of attorney, a healthcare directive, a clearly named beneficiary on every single financial account, IRA, 401k, life insurance, brokerage. These are documents that govern what happens if you have a stroke at 67 and can't speak for yourself for 6 months. They determine whether your spouse has immediate access to the accounts or spends 9 months navigating probate. I had a client retired at 64, solid plan, good savings, whose husband had a sudden cardiac event at 67. Survived, thank goodness, but he was incapacitated for 3 months. She could not access his IRA during that period without documentation. The beneficiary on his 401k still listed his deceased mother, never updated from 20 years prior. His healthcare proxy named a college roommate he hadn't spoken to in a decade. Nothing was designed for what actually happened. It was designed for a scenario nobody ever thinks will actually happen, until it does. Practical takeaway. Before you retire, update every beneficiary designation on every account. Execute a durable power of attorney and healthcare directive. Review your will. This takes one afternoon and a few $100s in legal fees. The cost of not doing it can be measured in years of legal complications and tens of thousands in avoidable probate expenses. Two more. Stay with me. Number 8, your portfolio has a concentration risk you've stopped seeing. This one is quick, but it matters. A lot of people who've worked at the same company for 20 or 25 years have accumulated significant company stock through stock options, RSUs, ESPP plans, or just never selling what they had. It didn't feel risky when it was 15% of the portfolio. Over time, it became 40%, then 55%. You've watched it grow. It's become associated with your career success. Selling it feels disloyal, or it feels like betting against yourself. Here's the reality. A single stock position above 10% of your total portfolio is concentration risk. Above 20%, it is a serious threat to your retirement security. Above 30%, it is, without question, the biggest financial risk on your balance sheet. Enron employees, Bear Stearns employees, Lehman Brothers employees. The people who held concentrated positions in their employer's stock didn't see it coming either. They thought it was conservative. They'd watched it grow. It felt safe precisely because they'd been watching it for so long. Practical takeaway, if any single stock, including your employer's, represents more than 10% of your investable assets, make a plan to diversify it before you retire. Not all at once. That can create a tax event, but a 2 to 3 year systematic reduction plan coordinated with your tax strategy can solve it. Number 9, you haven't run the retirement income simulation. Here's the last one, and the most fixable. A retirement income simulation is not the same as a retirement calculator. A calculator asks you to enter your savings, your estimated return, and your withdrawal rate, and tells you whether you'll run out of money. A simulation stress tests the plan against real-world scenarios: a market crash in year 2, a healthcare event in year 7, a spouse dying in year 10, inflation running at 5% instead of 3% for a decade. The difference is the difference between knowing your car has gas and knowing whether it can handle a highway in a snowstorm. Fidelity's internal research, drawing on those 7 million accounts, found that people who ran formal stress-tested retirement income simulations at least once in the 5 years before retirement made measurably better decisions about Social Security timing, asset allocation, and withdrawal sequencing. Not because the simulation predicted the future, because it forced them to answer hard questions before the hard situation arrived. Practical takeaway. Before you retire, run a formal retirement income simulation, ideally with a fee-only advisor or CPA who specializes in retirement income planning. One meeting, one afternoon. It will tell you more about the health of your retirement plan than any account statement ever will. At the beginning of this video, I told you that pre-retirees who fail to optimize their tax strategy in the 5 years before retirement leave an average of $148,000 in unnecessary taxes on the table. But here's the fuller truth. It's not just taxes, it's Social Security timing, it's healthcare coverage, it's long-term care insurance, it's beneficiary designations, it's concentration risk, it's asset allocation, it's the retirement income simulation you haven't run yet. Each of those 9 things has a window, and for most of them, the window closes right around age 65. Not because anything legal happens at 65, though Medicare does, but because the financial math changes. The income gaps close, the RMD clock starts, the Social Security decision gets made, the insurance premiums become prohibitive. The window that existed at 61 is simply not available at 67. That's what makes 60 to 65 different from every other 5-year stretch of your financial life. It's not just consequential, it's directional. The decisions made here set a trajectory that runs for 25 years and cannot easily be reversed. Here's the framework I use when I sit down with a client in this window. I call it the 5-year retirement runway. Year 1, tax trajectory. Model your tax bracket from now through age 75. Identify the Roth conversion opportunity. Understand your RMD exposure. Quantify the cost of doing nothing. Year 2, income architecture. Decide your Social Security strategy. Model the survivor benefit scenario. Map every guaranteed income source. Identify the gap between guaranteed income and essential expenses. Year 3, protection layer. Evaluate long-term care coverage, update estate documents, check beneficiary designations on every account. Make sure the plan survives a worst-case health event. Year 4, portfolio transition. Begin the glide path toward retirement allocation. Build the cash buffer, eliminate or reduce concentration risk. Don't do it all at once. Year 5, simulation and stress test. Run the retirement income simulation. Stress test against a bad sequence, a healthcare event, an early death, elevated inflation. Know where the vulnerabilities are before you cross the line. Here's what I want you to do right now. Pick up a piece of paper. Write down which of those 5 years applies to you based on how far you are from retirement. Now ask yourself, has that year's work been done? If the answer is no, you now know exactly where to start. The 60 to 65 window isn't dangerous because bad things happen in it. It's dangerous because it's the last time you can prevent bad things from happening later. And most people spend it waiting. Don't wait. If there's one thing I want you to take from today, let it be this. The window between 60 and 65 is not a holding pattern. It is the highest leverage planning period of your financial life. What you do here with taxes, with Social Security, with healthcare, with your portfolio will echo for 20 to 25 years. And unlike most financial decisions, these don't offer a second chance. The Roth conversion opportunity closes when RMDs begin. The Social Security decision is permanent. The long-term care window narrows every year. The beneficiary designations don't update themselves. The good news is that if you're watching this and you're still in the window, even at 64, there is time. Less time than there was at 60, but still time. I put together a one-page checklist that walks through all 9 of the things we covered today. What to do, when to do it, and what threshold to look for. It's in the description, no email required. And if you want to sit down and actually work through your 5-year retirement runway, model the tax trajectory, stress test the Social Security decision, review the protection layer, that's something we do with clients. First conversation, no cost. That link is also in the description. In the next video, I'm going to show you the Roth conversion strategy in detail. Specifically, the bracket filling approach that lets you convert the right amount each year without accidentally crossing into a higher tax rate or triggering Medicare IRMAA surcharges. I'll show you the exact math, the exact thresholds to watch, and the mistakes people make that turn a good strategy into an expensive one. That's next week. If you're not subscribed and you want to keep getting content that's actually built for where you are right now, not generic advice, not hype, not a product pitch, hit the button below. I'll see you in the next one.